It's footing. It is. PGIM's Michael Collins, Catherine Avery of Catherine Avery Investment Management. Catherine, good morning to you. We start the second quarter with this unanimous bullish call from HSBC. Do you think we're going to see some kind of capitulation move from perhaps left out of these record highs to real deployment as we kick into Q2? Good morning.
Good morning to you, Manus. Thank you for having me. Ever since we got the fourth quarter earnings numbers and we got some rekindled optimism from management, it's pretty much been off to the races, so to speak. But more importantly, we've gotten a broadening out in the market, which we think is going to continue. So a lot of those sectors that do have better valuations than the overall market, like the energy sector, financials, those sectors we think will still continue as we go forward because they're still continuing to trade at a discount to the overall market. And it looks like we have some renewed interest finally in those areas.
Yep, certainly waking up in the second quarter. Good morning to you, Mike. I just wonder to what extent you see this level of neutrality of exposure to IG, high yield and duration that HSBC talk about this morning. We're talking the talk, but we're not walking the walk. Are they in your world?
Yeah, Manus, good morning. I think investors in fixed income have become increasingly bullish on the asset class in general. And I think a lot of that is just the overall rate structure, right? I mean, the risk-free rate is really the attractive point. The credit spread, similar to equity valuations, have done nothing but get tighter and tighter. It's hard to say always if they're overvalued or fairly valued. But I don't have a sense credit investors are chasing, high yield, chasing emerging market debt. I think it's just kind of long-term investors, man, is whether they're pension plans, with all the insurance companies, with all the annuity sales we're seeing, are just trying to lock in this high level of overall yield. And I think they're just less sensitive to the level of the credit spread, right? The technicals in the market are really strong, meaning there's so much supply of government debt, public sector debt, and actually the net supply of private sector debt, corporate debt, et cetera, is coming down, right? So all else being equal, that leads to credit spreads getting tighter. But my sense is investors aren't over their skis in credit at all. And you're probably right that people are waiting for a pullback to get more aggressive. I know we certainly are.
Yeah, well, certainly that conversation this morning on Bloomberg Brief, which was about the mania waiting for a dip, well, the dip is only going to be pennies in size and scale. Let's just set the table for the Fed speak this week. There's a lot to deal with. The latest from Chairman Powell on Friday was this.
The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis.
Mike McKee is with me. What does not in a hurry mean? Mike, good morning.
That's what everybody has to decide. Basically, the market's taking it as the Fed is going to leave rates a little bit higher for a little bit longer. The yield curve steepening today. This is what happened on Friday. We got the PCE inflation numbers, and as you can see, the white and blue lines there, they basically show that inflation is still coming down, but at a slower pace. The slope has sort of eased, while the yellow line, unemployment, we get the unemployment numbers on Friday, has been going up a little bit, which suggests that the economy is slowing down. The Fed is looking at an economy, though, that is still producing 200,000 or more jobs a month. And so at this point, Jay Powell is saying we're not going to have to do anything. We get a lot of numbers today. As I mentioned, Jobs Friday is going to be the big day, but we do get the ISM manufacturing numbers today, JOLTS on Tuesday, services from ISM on Wednesday, and of course, jobless claims. And we have a whole bunch of Fed speakers this week, Bowman, Mester, Daly. Jay Powell back again on Wednesday. Kugler and Barr and Goolsbee all speaking as well. So we've got a lot of people to parse over the next couple of days, and we'll see if they join Jay Powell in saying the same message Chris Waller said last week, that we have some time ahead. What it means this morning is that there is a slightly greater chance of a July move. You can see the Powell gap there than there was last week when people were starting to move up the idea of June. Right now, it looks like the Fed may push it back till July, but expect, Manus, a lot of volatility. Even as this week goes on, as we get new data, people will recalibrate when they think the Fed is going to start cutting.
Yeah, we are continually recalibrating when they will pull that trigger. Mike, thank you very much, Mike McKee. My guests this morning are Michael Collins, Catherine Avery. Michael, the market has now moved to July for the first full lock of a cut. You look at the one year forwards, and you see a rate cutting cycle of 100 basis points, which is materially lower than traditionally we have seen.
Yeah, I think the hurdle, man, is for the Fed to cut rates, at least over the next months or even quarters, is very high, right? As Mike just said, the economy is solid, if not strong. The labor market is probably outright strong. Inflation is still stubbornly above the Fed's target. The stock market keeps hitting all-time highs. Credit spreads are bouncing toward all-time lows. Financial conditions are actually the easiest they've been since just after the Fed started hiking. So if you're the Federal Reserve, why would you ever cut rates, given those conditions I just cited, right? So the MO for them, the general tendency is to sit on their hands and do nothing until they really have to, until the markets really get pushed. So yeah, there are only about 2.5 cuts now priced in this year. So the markets are definitely moving in the direction of our view, definitely moving, I think, in the direction of the data, which is just let the Fed, let the markets play out, and the Fed doesn't have to do anything. But there are, these 100, even maybe 150 basis points of cuts priced in over the next, 18 or so months or 24 months. And that's really the hard part to gauge. And we're probably more inclined to take the under on those near-term cuts that actually get enacted.
And then, Catherine, I mean, this is the point. We're either desperate for a dip and we buy any dip that we see, but the cyclicality, the growth story, you can't deny it. We're probably going to get 200,000. Well, I don't know what we're going to get on Friday, actually. The consensus estimate is for 200,000 or thereabouts. And I've got to catch myself. About 200,000 jobs created. But that cyclicality, I know you like financials and I know you like oil, but what else in cyclicality? How do you play that strength story?
We still like industrials as well. Like names like Caterpillar it was a great, name for us in the first quarter. We think it's going to continue. That's a name that still, even though it's had such a run up in the first quarter, valuation wise, it still looks attractive. So I think you kind of have to follow the money. Where is the money going from, from GDP, or even, from fiscal spending? It's going into infrastructure and it's going into tech. So the beneficiaries of that are going to be a lot of the cyclical type tech names. It's going to be the industrial for the onshoring that we're going to be seeing here in the U.S. and then energy as well. And now that we've had China look like it's coming back into focus again, energy, again, these companies are still very inexpensive relative to the rest of the market. So you can still see a long trail ahead of them to have good performance.
It's amazing how the narrative for the market shifts from we don't need to talk about China, and we will do in just a moment in more detail, to suddenly, oh, China's back. Michael, right. I'm curious to know if you say that actually, Manus, you get this return in high yield and in investment grade and it's not stretched. Can I challenge you then, why are you lightening up? You say here that whilst tighter levels of spreads may well persist, we continue to reduce our overall credit in our portfolios. Is that just because you've had such a splendid run, or what is the motivation?
Yeah, I mean, it's a valuation story, man. It's clearly, I mean, we have seen over the decades doing this, right? Yeah, credit spreads, they hit the lows, and sometimes they bounce around these really narrow levels for years. Right? But the prospect of further spread tightening, meaning kind of capital gains on that credit risk, is really really limited at this point going forward. So just from a pure risk management standpoint, when you're looking at, upside, downside, the upside is, hopefully you clip that coupon for another few quarters or heck, maybe another few years. But wow, we know the downside, right? Spreads grind tighter and then they blow out when bad things happen. I mean, the good thing this cycle is if they do blow out, I mean, maybe we're just one of many waiting on the sidelines to add risk, but you do have that Fed backstop, right? I mean, I think they're going to be slow to cut initially, but when things go south, man, they have 300 basis points they could do almost instantaneously to support the economy, right? So that backstop is really in place for the first time in a lot of people's young careers in this business. So I think that's a reason to kind of be constructive on credit generally. But pay attention to the level of valuations, and they're in the lowest kind of percentiles historically. So you're just supposed to play defense and sit on the sidelines a little bit and wait.
Michael, you bear the scars of somebody that's lived through a few brutal cycles in your time. Stay with me. We've got more to do. That is Michael Collins, Catherine Avery, my guest this morning on Markets. Let's go under the hood.